So I think the expectancy equation is pretty interesting. Everybody should probably be aware of it, but I think it baseline expectancy equation doesn't really matter to most traders because, like, tell me if you ever oversize or undersize a position. So every single trade's the exact same position sizing. There's a variance there generally. Generally speaking, there's a variance there. And the expectancy equation doesn't account for that. Secondly, your risk reward. Your risk reward could be a 3R, could be a 2R, could be a 1R. And I don't know if people do the exact same every time. Like I said, I think that the expectancy equation really fits automated strategies more, but let's just look at it. And before I'll show you. I want to say, so this is the expectancy equation in blue. We know that one. But a lot of this is after you find a bunch of trades. Let's say the ledgers here is like risk 100, make 200, win. Risk 300, make 500, lose. And you just see the ledger of trades, and then you can derive a expectancy off of this. But I don't think that would be predictive of your ledger. This is just a summation. This is just a way of summarizing the data, shooting out an expected value of what happened during that time. But I don't think it's expectancy. I don't think you can expect that. The reason being is just because you're just summarizing this data. You're finding the average win. Why would it be the average win? Because you have some giant win? Why wouldn't it be a median win? Anybody? What about win rate? Average win rate? There is a standard deviation or a variance of your win rate, meaning you can win a lot during the last 20 trades, and then the next 20 trades you can just be in a drought. And yeah, average win rate, how many, okay, over a gigantic sample, it's not accounting for the variance in everything, and it's not it's not going to give us expectancy, which is literally the name of the equation, and I don't think that it won't give you an expectancy. Like, you can't expect that number because we have a variance in our win rate and we have a variance in our position sizing. Like I said, if we're an automated system, then perhaps this actually will apply, but most people are not automated systems. Most people are just trading and trying to, condense their trading strategy to become as consistent as we can. But so what I did was add a standard deviation, which is the square root of a variance. So all you need to do is we need to find how much our position sizing can fluctuate, how much our win rate can fluctuate. And I was thinking a win rate could be just over the past 20 trades, shoot me out an average win rate. Over the next 20 trades, shoot me out an average win rate, right? And then if you have a bunch of trades, you can see that it could be 16%, it could be 28%, then it could be 50% the next 20 trades. Like, there's a huge variance in our win rate, and that should be accounted for. So what I did was the best plan. So this is the baseline. We know the normal average is negative 7.3 dollars per trade is expected to lose. But if your win rate is on a positive one standard deviation and you have their same average win, you actually have a 40% win rate because the standard deviation is 12%. Meaning, best case scenario, if you keep the sizing the same and you're just starting to win a lot in this string of trades, way more than average, you're expected to make $32 per trade. So your expectancy can change drastically if your win rate changes, or if your position sizing changes, or if both of them change, which was which I would be, that would be awesome. So if you have heavy size and you're winning more, you would have, you would have a lot more money expected. I just want to do that quick. So 40% of $400, 161. 161 minus 105 is $56 per trade, or $56 per trade. So that's positive. So that's pretty interesting. And I just think that a lot of people might not, I don't know. I don't know. I also liked the expectancy equation at one point. I just don't think it applies to my trading because first and foremost, I have way too much discretion in my trading to have an equation summarize everything. Like, this is expectancy equation should be like, it's like a summary of after the event's already unfolded. There is no predictive power to it, in my opinion. It's just a way of saying how much money do you lose per trade, or how much money did you make per trade in your trading. That's the only thing. And I always thought it was like, well, if I stick to this, yeah. But in general, I do think it's important to know the average win rates of your 3R, 4R, right? So 3R is 25% inherent win rate. That means you have to be above 25% to be break even. That's why this comes from. That stat comes from an expectancy equation. Like 5R, you have to win more than 16.67%, right, to be profitable. That comes from the expectancy equation. But little did we know, we're not a robot, and our win rate fluctuates, and our position sizing fluctuates, where we're risking $100, we happen to lose, but then we risk $500, and we happen to win the 5R. Like, that changes the equation so much that it's just no longer applicable because your position sizing is way different. I mean, that's 5 times different, and that is not accounted for. And that's why we need to run a test where if you're position sizing heavy or position sizing light, what is the probability, guidelines. I think they're called confidence intervals, but I don't know. I'm just saying, like, in general, if you're performing well, you can be at this expectancy. If you're performing poorly with heavy size, it could be expecting this. And if you don't like that parameters, you don't like that gigantic move of probability, like it looks like this. If you don't like that, so this is your account value. This is the parameters. I mean, you can either have, like, that's basically what it is. And this is when you're oversizing and your win rate is higher. This is when you're undersizing or oversizing and you're losing a lot. And then this can be the 0 line. So you can basically see that there's all these different, paths that your account can take. Yes, this is the baseline, but if you're performing well, it can be way up here. If you're performing poorly with heavy size, you can be really negative. So the real parameters is the real expectancy is the entire picture, not this line, right? That's not your expectancy. Your expectancy is within these bounds. And that's positive 1 standard deviation of, you can use variance too, I don't know, or standard error, but whatever, doesn't matter. I don't think it matters. I'm not that technical. But that's what it is, man. That's your expectancy, not one frickin' digit or one line. All right. All right, Holmes. Peace.